on the local front, we've had this morning Kagiso's Asset Management releasing their Purchasing Managers Index for June, which was reported to have declined to 53.9 index points. And joining us now from our studios in Cape Town to analyze all of this and more is Abdul Davids. He's Head of Research at Kagiso Asset Management. Thanks so much, Abdul, for joining us this afternoon. Well, as I've said, we've seen that PMI figure come in on the local front as well, declining for a third consecutive month in June and hitting 53.9 points, and it marks its lowest level so far for 2011. A clear signal here that we're seeing a moderation in the sector's growth momentum.
Yeah, good afternoon. Thank you very much. Yes, I think that is definitely the case. If you look at the leading indicators, for example, that's also turned negative. Inventory build, that's a concern to us. And I think the overall outlook is less positive than it was, say, a month ago.
It's really in line with some of the global developments we've seen. Just how concerned are you at this stage?
I think there are quite a few warning signals that have been flagged. I think our manufacturing sector is under pressure. We continue to shed jobs as well. The job index, again, was down for the month. I think on the back of quite negative outlooks from some of the other global PMI numbers that we've seen today. So I think overall, in the context of a global economy that seems to be contracting, I think our numbers are a bit of a concern as well.
Especially given the fact that we've got the South African manufacturing production cycle, yes, closely tracking those international markets, but also lagging those developments. So does this mean things are set to get worse before it gets any better here in South Africa?
I think what we have seen is that the correlation between our South African PMI and global PMI, there's typically a 2 to 3 month lag. So the contraction that we're particularly seeing in the UK, the Eurozone PMI numbers, I think for the next month or even 2 months from here, we will probably still see that contraction in our numbers. I think what we have seen, the standard has been the Chicago PMI, the US one that has come out, and that much to the surprise of many participants, I think at 61, a massive expansion in the US numbers coming through. Now that could be indicative of manufacturing going back to the US, partly maybe because of the weaker currency. So I think those factors have obviously impacted on our numbers as well. Our currency has been strong. Manufacturing contraction we have seen in the local economy. So all of those factors, given the softer European outlook, which has traditionally been our biggest trading partner as well, is impacting on our numbers as well.
Of course, on a more positive note, Abdul, I mean, we've seen input cost pressures easing for the third consecutive month to 76 points in June. It's still far from that long-term average for the index, which sits at 69.2. But what's the sustainability of that downward trend as you see it, where we've got the rising inflationary threat still looming?
I think for the manufacturing sector, one of the key inputs is commodities like oil. Some of the coal inputs is also quite critical. And unfortunately, that is potentially where the rand strength has aided that side of the indices in terms of the rand commodities of those baskets coming down in rand terms as well. And that is a global phenomenon that we've seen in most of the PMI releases today, a strong contraction in terms of the price indices, the numbers coming through. So again, that could be a temporary phenomenon based on the current strength of the rand. If the rand had to weaken, you'll probably see that going up. And obviously, as you've mentioned, inflation is ticking up. What we have seen in terms of our inflation basket is more the food side of things that have been ticking up. The PPI numbers, I think, is bearing out the fact that we've seen that contraction in commodity prices and also rand commodity prices on the back of a strengthening rand as well.
Of course, where you've got those input prices increasing, one has got to assume that it's going to eventually be passed on to the consumer. What are you making of the sector's pricing power right now, and what that trend that's soon to take place would have on consumer demand and so activity moving forward?
That's a very important question. We have seen a contraction in business activity. Also, there has been some inventory build as well, which suggests that there might be a tougher time ahead in terms of suppliers and manufacturers' ability to pass on those price increases and cost increases as well. Bearing in mind, as I've said, the rand has been relatively strong on a year-on-year basis. So our manufacturing sector is competing with imported product, notably from China, for example. So that ability where your competitors is obviously faced with a benign currency outlook or even a flat currency outlook and your currency is strengthening, it becomes much more of a challenge to pass on your cost increases when you compare to imported competition as well.
What's your outlook on the rand, Abdul, from here on out? Because that is one of the key factors that will be considered, where it affects exporters, for example, and the strengthening of the rand hampers their revenue earned. But where, as you say, there is a benefit and that other side of the coin to consider in tandem.
Yeah, I think again we have seen this decline over the last couple of years, and I would say couple of decades as well. Our manufacturing base has continually shrunk over the last couple of years because of factors like the rand. Unfortunately, it's not ideal. I mean, ideally, you don't want to be just beholden to the currency, but that is one of the critical factors because we know that the local demand, local purchases are always benchmarked against what imported competition and imported products can be priced at. So in that environment, it becomes a critical factor, especially if we have seen the magnitude of the strength of the rand as well. So even though we don't think it's an ideal scenario of just wishing for a rand weakness to benefit for our manufacturing sector, it is a critical and very important factor to consider as well. So I think from here, our outlook certainly is that we should see some rand weakness coming through. Having said that, I think the current strength of the rand is much more a factor of dollar weakness rather than particular rand strength over the last couple of years or so. So it might be an environment where the rand continue to strengthen or even stabilize at these levels, given what is happening in the global economy and in the US in particular.